From Ben, I bought deep out of the money DIA puts expiring 31st of March 2022. I did miss that. I put the standard expiration, but that's okay. Now, I realize they're going to expire worthless unless the Dow completely collapses between now and March 2022. Okay, so no change. He's deep out of the money, but we have a 50% profit right now in their position. Is there a time frame or indication I should look for to close those puts? Now, you have repeatedly said pick a goal and use that. Absolutely. All strategies, there's always a trading plan. I believe the market is going to make some corrections between now and then, but if I wait too long, the probability of those OTM puts being ITM gets very smaller. Yes, and the profit you have right now, Ben, since it is an out-of-the-money option, is all time value. So the longer you wait, the time value is still going to decay out of that position and get closer to zero. Now, there's a presentation I want you to watch because I couldn't polish this one as quickly, Ben, from the timeliness of when your email came in. I didn't have a chance to put this together in reverse. But there's a video, 8 ways to manage a profitable long call. We're going to cover some of this, but later on this weekend, you might want to check that out. You can go to YouTube, our YouTube channel, of course, Ben. Search 8 ways to manage there on the magnifying glass on our videos, and you'll see the 8 ways to manage a bull put spread, since we just talked about those for Len. 8 ways to manage a profitable long call position. You can also see it on the Power Options archive, powerop.com/webinars.asp, 8 ways to manage a profitable long call. You'll be able to flip some of those ideas to apply to the long put, of course, in those scenarios. Although it's a little bit different, I will admit that this video here on 8 ways to manage a profitable long call was, I think, an out of the money or at the money option that was bought. The stock had moved up, so now the call was deep in the money. You're not quite there yet, but you do have a 50% profit on the position that you're going to be able to get into and also do some manipulation on potentially with some adjustments as well. All right, so all that being said, since I didn't get a chance to prepare more slides in relation to this, let's navigate over to Power Options. There we go. And what we're going to do now is link right to the portfolio. And I had put one in, but as I had mentioned, I selected, Ben, the wrong expiration date. But the rules and ideas will still apply. Here's the 18th of March, 300 put, still 105 days to go to expiration. The current put is at $6.23. I know this is not your put, Ben, but this is an out-of-the-money put with DIA at 346. So we're still, what, 11, 12% out of the money on this position. Need a big decline in the Dow to have that go in the money. And of course, I know the expiration date's wrong. You're on the quarterly at the 31st of March. I'm looking at the 18th. But anyway, I put in, what if I had bought 10 contracts at 410? Currently trading at 623. So I have a profit here of $2,125 or 51.8% had I bought this position. I put in November 1st, but whatever it was. These aren't real numbers. This is just to showcase the ideas. Now, I don't think I'll see anything here, but let's take a look. Go to Position Actions and go to Position Analysis. This gives me a breakdown of the position. I know I can see my current liquidation value. And yes, as Ben mentioned, if I hold it all the way to expiration and the stock doesn't fall, I don't do any adjustments, I can lose 100% of what I invested into this long put. Now, there are some rollout opportunities. We could roll it to a lower strike price. This is shown usually when you have about 100% profit. I'm not going to suggest doing this in this case, okay? It's going to drop your break-evens down. You're going to take some profit of this and have a lower profit here for the lower strike put position. If I had a put that was now in the money and was near 100% profit, rolling down would be a great idea. Rolling to a lower strike price, taking most of that profit into myself, and then using that to buy into some of the lower strike put options, that would be great. In this case, your fear is more about the decline and what's coming forward as opposed to what to do now. Okay, so what are some other concepts if we're not considering that rollout opportunity that was shown for this deep out of the money put? Although It would allow you to take in some profit now, buy a cheaper put, and if Dow did collapse as you felt and had other fluctuations, you might still get profits on those between now and March also. But again, let's go back to our portfolio. Let's not go to the bull put. Let's go to the profit and loss chart. All right. And there we go. So what are some of the things that you might consider? Well, we saw that the rolling down concept. I don't think that's necessarily a good idea. Rolling up to a higher strike is going to cost more money. But what if I just sold half? Now that's a possibility, by the way, rolling up. Let's go ahead here and take the 300 puts here. And I'm going to say that I'm going to sell 5 of those puts at 620. Let's call it 622. Let's take the 5 out. Okay. So what am I doing? I'm pocketing half of $2.10 of profit, which gives me a cost basis now in the position of only $990. You're pocketing some profit right now. You're taking back in $3,110 by selling half of those puts that you own. That lowers your cost basis to less than $1,000, essentially, or let's just call it $1,000. So now what do you have? You've got a risk still of losing $1,000. You've limited your exposure in this case, and if the fluctuations still occur over the next 20, 30 to 40 days, maybe 50 days max, you still might see some additional profit, because think of it now, you just own 5 puts at a total value of $990, so it's less than $2 per contract that you have on that position. So if those puts now go up to a price of, even if they start to lose money and they go down to $350, you're still at a profit on the remaining 5 puts that you have available. Selling half is always a good approach when you're at a 50 to 60% loss in that case. Your question had also come into the factor of what should I set as my stop? That's hard for me to answer. I don't know your game plan. I don't know your goals, Ben. I'm not your financial advisor, of course. 50% on a profitable long call or long put is good, provided, as Fernando just mentioned in the last discussion, that you also take money management on the other side and you're closing your other long puts and long calls in this portion of your portfolio if you hit 50% of the maximum loss and don't let it go to 100% of what you could lose on the position. In general, I'd say that Ernie, and sometimes myself, you might consider it greedy, but we tend to look, him more than I'd say, he tends to look more for a gain of 75 to 80%, I believe. He'll usually get out or at least sell half, or sell out at a ladder pattern at 50%, then at 70%, then at 80%. I had a coaching session with a gentleman the other day, and that's his approach. He'll have maybe 6 to 8 or 10 contracts of long call or long put. When he hits 50%, he'll sell 2 or 3. He hits 75% profit, he'll sell another 2 or 3. He hits 90% profit, he'll sell another, something along those lines, if he's lucky enough to keep seeing it. But what is he doing? He's lowering his exposure and taking in some of the profit now, essentially to lower the exposure he has. He could still have a loss of $990, don't get me wrong. But if the trend continues and he was right, he gets less exposure here in case he was wrong, and then he can manage it, takes another sum off of it, maybe drops the whole cost basis down to $440 for 4 contracts. Now he's under $1, or right at $1 per contract, loss of $400 with 4 contracts remaining, so on and so forth. So that is a good approach. Now, another concept you could do, and I don't know if this matches your criteria at all. Okay. The stock is down. You're way out of the money, excuse me. The stock is up. You're way out of the money here on this position. There is a possibility that you could convert it to a calendar put spread to get some income to pay this down, or even a debit spread by going in the same expiration. What was your cost basis? Sorry, folks, it was 410. Not a bull put credit, but look here, maybe even here at the 280 put. I've got the 300 already. I sell the 280 put, 390, 435. That's going to give me 410. And that's, what did I do? I just paid for the position, but you're right. I was hoping for a little bit more. This creates a bear put debit spread where you could have a big profit here, but you're not expecting that. But you do cut the cost basis down in that case. That's not what we want to do. We could go the opposite way if you didn't mind putting up some additional margin. And you could create a bull put credit spread. 600 risk here. I'm sorry, 400, you've got the profit there. Sell the 310s at around 755. This is going to be a bull put credit spread, but it's going to be it still has risk, doesn't it? I thought it would be a no risk spread, but it's not. It's a 10-point spread, and I've only got a $3,600 credit on the position. But as long as DIA now stays above 310, you can make $36.25 on the position. Both puts expire worthless. It's a possibility. Might not be what your expectations are going forward if you're still hoping for corrections and declines. If I'm in this credit spread and you start to see some of those corrections, the core spend that you were talking about, maybe in December, maybe in January, we'd see this bull put credit spread maybe start getting into trouble in that case. You'd have to put up the margin to cover the spread depending on how many contracts you have. Of course, you could do a combination of the two things we just discussed. I could sell half of these again, get that cost basis of these 5 remaining puts down to about $2, and then enter the bull put credit spread for a higher premium. Maybe have only a 5-point or have around a 5,000 point credit on a 10-point spread. Pretty close to a 1-to-1 risk reward ratio. But again, if your expectation is expecting corrections, I wouldn't want to see you enter necessarily into a bull put credit spread as a management technique. The calendar spread is an option too, selling out of the money puts against it shorter term. Looking to December, let me go further out. Looking for December, say 17th. Whole bunch of strikes to select. Again, we could maybe consider the 330 now because you've got the 300. I'm sorry, I put you as 300, so I'd probably want to do a 5 or 10 point. But I can get almost $1 for this one here at the 305 strike. Now this means you'd still have to cover the margin, even though this is a calendar spread. Your put, though, is at a lower strike. The put you bought is at a lower strike than the put you're selling, so you'd still likely have to cover the 5 points with your broker. Hopefully they'd match it up and not consider this 305 a naked put if they don't link it to the long put that you have. I've seen that happen sometimes in the past. It's kind of frustrating when I talk a customer through it, because if it's entered at once, they would have counted it. If you legged into it, sometimes they don't look and they want you to put up the full margin requirement for this naked put option in this case. I mean, this looks pretty good, but no, it doesn't if DIA keeps doing the opposite of what you expected in that scenario. So that's why we build these structures to see. And it's 17 days away. Your stock price is right here in green, but if it keeps going up, this position would start to show a loss. Now, I'm not saying I'm expecting DIA to go up to 360. I'm also not expecting DIA to drop down to 330 or 310 or 305 where the sweet spot is, okay, in the next 14 days. But again, those are some ideas. What are we doing here? We're lowering the cost basis of the initial position. We have the potential to take the profit now, of course. Just take it and go away. 50% profit, not bad. Restructure, take some of that profit, maybe look for a different put, maybe a higher strike if you still think Dow is going to have some corrections. That would be the same, akin to almost rolling up as we talked about, which would increase a higher debit, but you might get the profit faster with a less out of the money put, taking the profit on this one to lower the cost of those higher strike puts, let's say at 320 or 325. More expensive, but if you, for example, have 10 contracts here at this price and you've got the 50% profit, you don't necessarily have to buy 10 contracts of those higher strike puts, 330, 325. You could buy 2, you could buy 5, buy 7, so on and so forth as well. Okay. All right. So, sorry, hopefully that doesn't show up. It's just a comment from Fernando. It's a good comment. But the other thing I wanted to mention, why do I keep talking about here, Ben, this conversation of December and January? Okay, and the reason I keep bringing that up, let me go back here real quick. Okay, I want to try to get to something. There we go. I'm sorry, folks. Let me go back over here. because I wanted to go back here very quickly. Perfect. Okay. So wanted to get to my desktop. It wouldn't let me show it if it was there, but I wanted to pull this up here, and I increased the size, I'm sorry, so it got really grainy, but you can see what this is. This is your time decay curve. Fernando says at same expire, you can sell a put out of the money, plus on the other put more OTM to push up the payoff and be theta positive and wait. Okay. So what he's talking about there is something similar that we were discussing, but on the other put, sell a put out of the money, plus on the other put more out of the money to push up the payoff. But looking to control theta. What is theta? Theta is this time decay we started talking about, but not directly. Why do I keep talking about December and January? Your put is 105 days away. Yours is a little bit further. I'm sorry. I'm looking at the standard expiration of March 18th. So yours is 118 days away, I believe, to the 31st, if I'm not mistaken. This is the time decay curve of what you expect. Yes, now prices change. Volatility is going to change. But we're at 105 days to expiration now. You're an out-of-the-money put that is all time value in this 105-day range to expiration. You still got a good 20 to 30 days of a slow decline on the slope. Once you hit 60 days, that accelerates by about 50% more decay than you expect from 90 to 60 days. So where is this 60 days? It's about 30 to 40 days away. You're going to cross that 90 mark in about 10 days. You're going to cross the 60 in about 40 days, and beginning of January, middle of January. And then it just drastically accelerates naturally as you start getting in. As a general rule, if you haven't done so yet, you're holding this out of the money put that maybe still has some profit, maybe not as much as it is today. Maybe you close some of it, which is always a good idea. Closing half, lowering your exposure, lowering your cost basis, and then, hey, leaving half there to see if you can still get profits if these corrections you're hoping for, little blips here and there, maybe big blips, if you're hoping for that, do occur, you can take profit on those other sides as well. Once we get into within 60 days to expiration, would be around January 10th, somewhere along those time frames, somewhere in that range, January 10th, January 12th. Then you're going to start seeing more rapid deceleration, more rapid time decay. This is what Fernando's referring to, because you want to try to get to a more positive theta area, the time decay area, by using premiums from selling other puts against it, and maybe restructuring the trade. You could sell half and then maybe sell a put against it to kind of fight the theta. One theta, the put you sold, is working for you, while this remaining theta of the remaining puts that you have are naturally working against you. Okay, so that is another option that we kind of looked at a little bit. But remember, if you're selling a higher strike OTM put on this position, you'd have to cover the margin. And if you're selling lower, check the structure first to make sure you're still getting a positive reward at the end. And you'll see probably a more positive reward, as I mentioned, by taking some of that profit now. Okay, so that's 60 days to expiration. This is more of the direct answer to your question, other than some of the management concepts you could use, Ben, because you said you wanted to have a game plan. You wanted to have rules of thumb. Yeah, Ernie and I might be a little bit greedy, looking for the 75 to 80% profit when you have a 50 to 60% profit on a long call or long put with still time to go. That might be a good time to sell half of the position. Take some of that, lower your exposure, or use some of that short-term or longer-term theta to help start paying down the cost and also lower exposure, or combination of both in those scenarios. Okay, and again, you could roll up, cost more money, but at the same time, you might see more profit faster. You're helping adjust to break even by doing that in those scenarios. And those are some of the considerations to do. But that check mark, that checkpoint, when you start to get within 60 days, 55 days remaining to expiration on the position, that's when you should consider getting out with the profits you have, because it's going to start decaying. If you're not seeing the moves you're expected, you don't have, I apologize, you don't have a strong sentiment. Your sentiment in the market as a whole, Ben, could change. We know that 20 to 30 days from now, it could look very much more bearish for you, and that would be great in this position. Some things around the global theater, politics, strategies, everything else might change as well. We might actually be looking at a market that seems to us to be more bullish in the next 20 to 30 days, in which case, hey, maybe I want to get out of this one, take the profits I have. Maybe now I'll look at some out of the money calls on DIA if my sentiment has changed, of course, in that case also. Okay. Yeah, it's Fernando adds it on his idea, using that selling the OTM premium to get theta positive in that scenario and another out of the money put, you now have a vertical debit spread as a parachute in case of a decline. And that's what we kind of saw with that first move, but it wasn't exactly what Fernando was referencing to. But just doing that bear put debit spread I showed had a no risk position if the stock stays where it is, but you weren't seeing the profits you have right now. But if it did decline, that vertical bear put debit spread would look much better in the case of that as well. All right. And Ben says, numbers are very close to the options I'm holding. Some good ideas. I'll play with the numbers. Definitely watch your time remaining. Absolutely. And of course, Ben, as you remember, a little bit more of a polished presentation, not directly related, but goes through some other ideas. You can take a look there again, the 8 ways to manage that profitable long call position. And that'll help you look at some other concepts that we talked about for Austin. His was a little bit different. He had some other opportunities because his call went from out of the money to in the money, and he was at a higher profit, I believe. But you'll be able to see some of the ideas in motion and see if they can apply to you, playing with the numbers, evaluating them on the profit and loss chart on power options there, and trying to get a good gauge of, hey, what matches your tolerance? What matches your goals for the strategy? 50% is a good stop. Mentioned being greedy, but 50% is a good also trigger alert to maybe sell half of it, take your profits, and take some profits, lower your exposure, and then see what other opportunities we might have to further manage the position.